Hi, it's Thomas. Welcome back to Business Strategy. Today's lecture is the internal environment. We can talk about internal environment from a couple of different perspectives. One would be our SWOT analysis. The strengths and weaknesses relate to the internal component of that analysis, and we've already covered that concept. So we'll look at the internal environment from another perspective, which will be more of a fundamental analysis of why our entity exists and some conceptual components of the entity. We'll start with the concept of organizational direction and looking at our mission, our vision, our values, and our goals. Our mission is basically our reason for being. What is our purpose? What, who, how? What are we doing? Who are we doing it for? And how do we do it? That's our mission. The vision is a longer term concept. This is our statement, our idea of what does the optimal future look like. So as an example of a mission statement and a vision statement together, a medical firm might have the mission of supplying first-rate medicine in the fight against cancer, and the vision might be no cancer. So those are two different concepts, but they work together, and the vision is clearly a longer-term, more ideal concept, whereas the mission is a bit more, not necessarily short-term, we could say intermediate term, and perhaps a bit more of a concrete concept. Moving on to values, the foundational principles and standards of an entity. So the values really are coming first. Based on those values, what is important to us, what are our priorities, what do we stand for, then an entity would develop mission and vision statements. The values rarely, if ever, change. The vision rarely changes. The mission might change, although that happens rarely as well. And finally, goals and objectives. We'll refer to goals and objectives in more detail in the next slide using the acronym SMART, S-M-A-R-T. Goals and objectives should be SMART. And in regard to the relationship between these two words, objectives are typically the shorter term steps that lead toward your goals. So the objectives happen, you could say that a goal can be broken down into multiple objectives. Sometimes the words are used interchangeably. In either case, whether we're using the word goals or objectives, they both relate to the same progression here, the same concept, SMART. First, specific. We need to have specifics in what we're trying to achieve, not expand internationally. Something more specific would be expand into 3 new countries in the next 3 years and 2 additional countries in the following 2 years. That's a specific goal. The goal should also be measurable, and often specific goals fall in line with measurable goals. If we have a specific goal in mind, and especially when we have quantified the goal, then we can look, and when we are at a particular point in time or particular progress in our entity, we can look and answer the question, have we achieved our goal, yes or no? We look at what is measurable and we can decide whether we're there or not. Next, goals should be attainable. They shouldn't be easy, but they also shouldn't be impossible. Goals that are too easy to reach aren't motivating, and goals that are impossible to reach are demotivating. So our goals should stretch us. They should stretch the entity. They should be challenging but attainable. The goals should also be relevant. If we think back to the concept of our mission, our vision, our values, the goals that we set should be relevant to those concepts. So there's a connection between why we exist and what the goals are that we're setting. And then finally, goals should be timely in the sense that there's a deadline. Goals aren't just set with no timing component to them. Goals are set with a deadline. It could be a week, it could be a decade, it could be longer. But goals need to have a timeline, a deadline, so that we know what we're working towards and we know when we expect to achieve it. When we evaluate our goals, if we haven't met one of these 5 requirements, then we should revise the goal. So we have all 5 of these requirements met when we're writing our goals, and that makes the evaluation of the goals much easier and more effective. And finally, we'll look at the concept of corporate social responsibility. This, we can say, is a component of the concept of ethics as applied to an organization. So corporate social responsibility is a relatively new concept, and just as with all of the concepts we're discussing in strategy, this is relevant not only to corporations, in this case we have the word corporate in this name, but the concept also applies to governments and to NGOs. The first concept is the triple bottom line. Most corporations are focused on net income or profit or cash flow, some kind of financial measure. But the triple bottom line expands that to consider social or the people factor, environmental, as well as financial components of our evaluation. That's the triple bottom line. Next, with the rise of social media, Facebook, Twitter, etc., there's a much more perhaps intense or a real-time connection between organizations and their customers, their employees, their stakeholders, and this is resulting in increased consumer accountability. The consumer has more direct, more real-time contact with corporations, and again, that is not just corporations, but governments, NGOs as well, and the result of this stronger real-time connection is a higher level of accountability. If a stakeholder sees an entity, an organization doing something that they don't agree with, they can immediately make a statement, and they can share that statement with a large number of people very quickly. That puts some pressure on the entity, and that holds the entity accountable on a real-time basis. We can summarize the concept of corporate social responsibility from an ethical perspective as the right thing to do. In other words, putting ethics above the profit motive of the corporation. That's the ethical perspective. From a financial perspective, keeping in mind the triple bottom line, one of those components is the financial component. From a financial perspective, this phrase, higher costs in the short term will lead to higher profits in the long term, is a great way to tie corporate social responsibility to the profit motive, to the financial component of the triple bottom line. Usually, corporate social responsibility means you're going to spend a little more money in the short term. You might only work with suppliers that meet certain minimum requirements, either based on ethics or based on law. That will tend to cost more money. In the long term, your commitment to social responsibility will attract more customers, more stakeholders, more participants in your organization. That will give you more success. And if you're a corporation aiming towards profit, increased revenue as a result of your commitment to corporate social responsibility will over time offset your increased costs and lead to even higher profitability than you would have had if you wouldn't have pursued corporate social responsibility in the first place. So this concludes our lecture on the internal environment, and we'll look at these concepts more closely in class during our case study analysis.